Expectations for strong earnings growth, looser regulations, and lower taxes are some of the things that have driven the market higher since the election. In fact, the rush of optimism has been so strong that even some bears have turned into bulls. As Mike Santoli reports, that group think may not necessarily be a good thing.
The so-called Trump rally has investors looking on the bright side again. A recent pickup in economic growth and hopes for business-friendly Trump policies have lifted the Dow Jones Industrial Average more than 8% since Election Day and boosted several measures of investor confidence to levels not seen in years. That's the good news. In the short term, though, signs of over-optimism are flashing a caution signal for stocks, a hint that immediate further upside could be limited with the bullish bandwagon looking pretty full. Surveys of both professional and individual investors have shown an extreme surplus of bulls expecting higher share prices over a shrinking group of skeptical bears. Cash has rushed into exchange-traded funds that track big U.S. stock indexes at a pace not seen for 2 years. And the Conference Board's measure of consumer confidence hit a 15-year high at last report. While positive for household spending, such high confidence readings are associated more with rallies nearing a high than one that's set to speed even higher. By Wall Street's often contrary logic, extreme optimism typically means stocks are set to stall or perhaps dip in the coming weeks. Right now, this setup is complicated by the fact that many sectors, such as bank stocks and industrials, have surged since the election on those hopes of quick tax cuts, deregulation, and new infrastructure spending under a President Trump. As the inauguration nears, investors are struggling to handicap the chances for quick progress along these fronts. None of this says that the good times are over for the market. The rally has been impressively broad, and corporate earnings are poised to recover from their 2016 tailspin in the coming quarters. Still, the best thing for stock prices in the longer term might be for a brief market setback that dims investors' enthusiasm for stocks. A less crowded bandwagon has a better chance of moving ahead quickly. For Nightly Business Report, I'm Mike Santoli at the New York Stock Exchange.